So I would like to introduce my panel. Gunnar obviously doesn't need an introduction because we have done this prior to his presentation. So obviously ladies first. So we start with Barbara Cohen. Barbara serves as Executive Director and in charge of reviewing and approving credit methodologies at Scope Rating, which is the largest European credit rating agency. And there she particularly focused on the fundamental credit and the integration of environmental, social, and governance factor in the analytical approach. Prior to her job at Scope Ratings, she has worked for 18 years at BNP Paribas Asset Managers, out of which 10 years as a global head of credit research team. And prior to that, she has also worked at BNP Paribas Asset Managers as head of fixed income research. And besides her capacity in a day-to-day job, she chairs the Credit Commission at the French Society of Financial Analysts SFAF. Barbara, we're glad to have you here on board. Obviously, we're coming to Alexander. Professor Bassen is a full professor of capital markets and management at the University of Hamburg, Faculty of Business, Economics, and Social Science. He teaches courses in financials and in finance and investment, ESG and capital markets and reporting.
Yes, and I don't see no. I'm here. Hello.
Now we just have to switch to Alex again. Sorry for that. Okay, I will continue with the introduction nevertheless. So besides his day-to-day job at the University of Hamburg, Alexander is a member of the German Council for Sustainable Development. This is the advisory body of the German federal government and the Sustainable Finance Advisory Council of the German federal government here in the German environment, which is a very important body. Besides that, and actually even more important on a European scale, he serves as a member of the EFFAS Project Task Force EU Sustainability Reporting Standard. And besides that, he's an honorary research associate at the University of Oxford. And besides that, a visiting professor at the Hong Kong Baptist University. So I think, Alex, having said that, we all know that you are not short of time besides the day-to-day job. So we are very glad that we have you here on board. And nevertheless, you will come back to us afterwards with the CESGA program, having said this.
Yeah, thank you very much for the invitation again.
Thorsten will complete our panelist. Thorsten Müller is managing partner at Lighthouse Corporate Finance in Frankfurt. Besides that, he is a board member of DVFA and a co-chair of the EFFAS Capital Markets Commission. And prior to his actual role, he had different jobs within the investment banking division at Commerzbank AG as well as WestLB. And in addition, he is member of the DVFA Commission on Corporate Analysis. So, Thorsten, we're glad to have you here on board as well. So, when we take the topic of this panel, latest trends in ESG, I think there's a very wide field. And as you obviously could realize, the panelists have a very diverse background. And having said that, I would like to give every one of you 5 minutes as an introductory statement so that we here in the room and also the audience online can get an idea what you consider personally as the latest and important trends in the ESG environment. Barbara, if you would start.
With pleasure. With regard to credit rating agencies, since March 2020, the regulator, our regulator, ESMA, is requiring us to provide greater transparency around whether ESG factors are affecting credit rating actions. So since this date, credit rating agencies are progressively or have already introduced, this is our case at Scope, and I'm sure this is also the case for the other three big rating agencies, have introduced ESG factors within our methodologies. Methodologies are now describing ESG-led factors which impact an issuer's creditworthiness. With regard to the fixed income market, more globally speaking, this is an over-the-counter market involving lots of different stakeholders, lots of different issuers. The very wide variety of issuers type implies a lot of differences with the way they are disclosing information, financial information, or non-financial information. So the variety of this universe is made of listed companies and non-listed companies. Listed companies can be, of course, large cap and SMEs, and non-listed companies can be also large companies and SMEs. That can be also subsidiaries, non-listed subsidiaries owned by large groups. Issuing bonds that are not guaranteed by the parent company. So the access to information is obviously crucial, but it is even crucial to get access to the financial information itself. And we find so this is a discussion we have had, we have clearly within the Capital Market Commission, but also within our Credit Commission in France, within SFAF. It is very often challenging to access the basic financial information for the non-listed part of our investment universe. And the main reason that we flagged, we identified, is due to the lack of regulation applied to this part of the universe. On non-financial disclosures have been also designed for the equity world first, primarily. So this also implies lots of things for the investment universe of the fixed income market, where you have still a large part which is non-listed. Furthermore, ESG data providers are totally focused on listed companies. So it's very complicated, and when you have to invest based on ESG factors, ESG criteria, when you are a fixed income portfolio manager, it can be very challenging. We identified two consequences. While for large issuers, asset managers have a lot of information, non-standardized, of course, not always relevant, which is mostly coming from these ESG data providers. But this data can be used in a systematic analysis or in a systematic approach. On the other side, for the unlisted part, the asset manager have to allocate more resources to catch this ESG approach and to build its own ESG, not only strategy, but also to build a set of resources to allocate to this to this part of the universe. We also identified imbalanced access to information between bondholders, but also between bondholders and bankers. We have seen recently an increased volume of sustainability-linked loans issued on the market jointly with banks with ESG KPIs, but these ESG KPIs are not falling in the public domain. So for investors that are investing in the same companies, they have not access to this kind of covenant. well, we discussed a lot with my colleagues at EFFAS, at SFAF, and we are really converging to the same conclusion. We should really build in Europe a converging regulation toward more homogeneous, with a more homogeneous regulation across Europe, across countries. At least on the financial disclosures, at least. So this should be the minimum. We have this marvelous format for investment grade issuers, which is named the European Medium-Term Notes for investment grade issuers. And it does not include a set of minimum safeguards or standards to publish in terms of financial disclosure. So could be nice to force a little bit further the issuers, at least the investment grade universe, to issue more financial data. And we have a project also at the French Credit Commission that we want with Thorsten to extend at the European level to build, to have a work group working on the best practice or on a guide on best practices for debt issuers in order to better identify where are the truth and what can be improved, and also to give some guidances and clearer guidances to the debt issuers. I think I spoke too much, but thank you.
Thanks a lot for this introductory statement. Alex, would you like to continue?
Sure. Yeah. Thanks for inviting me again. I have three aspects I would like to mention what are trends we do see right now. First of all, something you discussed this morning already. I mean, you invited Patrick de Combourg, who is the head of the project task force for the mandatory sustainability reporting standard. You had the panel on reporting, where Carsten was also there as a member of the platform. But what I would like to stress here is the question and the trend I do see in terms of granularity of information. And on the one hand, and also the trend we do see with the two separate developments. On the one hand, we do see the European development, what EFRAG is doing right now with the standard, and we do see the international, more global development, what the IFRS Foundation or the ISSB is doing right now. So having said this, I think it's very important also from an investor's perspective to align these different trends as far as possible, especially because the understanding of materiality of these two different reporting standard setter is different, as you know, as you discussed today already. Why do I stress that? Because I think that this is closely linked to the second aspect I would like to mention here, and that is the question of impact. I mean, most of you are now, if you just hear impact, you think about Article 9 and objectives you have to define. But I think that this is just one part of the discussion we do have right now. Because when we talk about the whole question of impact, I think it's very clear and necessary to separate between impact aligned investment and impact generating investment. This is not exactly 8 and 9 of the SFDR. It's a broad understanding, and it's based on the development we do see for impact investing in the last, I have to say, 15 years at least. So because the whole discussion on impact is probably new to the organized capital market. But if you think about social enterprises, social entrepreneurship, there it's really established tool. So therefore, I think it's very important to clearly define and clearly understand what the impact of investing is. And yes, I think that also equity investing can generate impact. So the impact generating investing, which is usually not only linked to the strategy, but also very clearly linked to engagement. I think this is something where we have to be very clear. When you talk about impact aligned investment, I would like to draw your attention to an index we just recently developed together with the United Nations. That is an index that is linked to the Sustainable Development Goals. We did that in 2 steps. That means, first of all, we identified the effect or the link between products and services of companies with the SDGs. On a second step, we built in a traditional ESG filter. So I think it is very clear to separate that, because this is something that customers do expect from the fund management industry, to have a very clear understanding and not to drive the business only to make sure that you are at least 8, even better 9. So these are 2 of the components I would like to stress here. And the third one I would like to address, which I think is also a trend we do see right now in terms of regulation. And I would like to come back to the European perspective, because what we do see here right now is not only the taxonomy we talked about, it's not only by the Corporate Sustainability Reporting Directive, the CSRD, it's also the upcoming Sustainable Corporate Governance Directive. And what worries me a little is the question of how are these different initiatives linked? So something we would like to, well, accept that there is such a link between this different regulatory initiative is not necessarily the case. So that means all these overlapping, these unclear regulatory situations is something where we have to, which I think simply have to accept. This will definitely be a trend we will see in the next at least 2 to 3 years, that we have different regulations, also the SFDR, of course, who are not 100% perfectly linked to the other European regulation. This is a challenge, but I think in this alphabet soup, we kind of have to survive. You have to survive as fund managers, and happy to discuss that in detail later.
Thanks, Alex. Thank you very much for your introductory statement. Thorsten, would you like to continue?
Yeah. So let me just give you some brief data for setting the scene. This is, this is a table dated March 21, so half-year old, and we've been discussing ESG, but for what companies? We have been talking about ESG for multinationals, for big companies exceeding minimum 1 billion euros market cap. Probably you have ESG ratings for companies perhaps at 3 billion market cap. So the ESMA analyzes that 74% of the companies listed in Europe have a market cap less than 200 million euros. If we have the threshold 500 million euros market cap, we have 80% of the companies are below market cap of 500 million. And if we take the threshold of 1 billion, we have 86% of all listed companies in Europe that can be considered SME. So we talk about a huge universe, 86% in Europe, and this is probably the number of listed companies that do not have an ESG rating. We talk about really blue chips generating ESG data, and I just learned Microsoft started collecting ESG data back in 2008. And now we start in Europe to say, you have to disclose ESG data either today or in 2 years' time. So this is a major challenge. And what I'm really concerned about is, and let me just put it into a bigger picture, we have the Capital Markets Union, which is still on the agenda. And there is the EU Action Plan that covers 15 points we have to address in order to have more efficient capital markets across Europe. 6 out of these topics are related to SMEs. So the European Commission clearly states we want that fresh money goes to SMEs. But what do? We want to have more IPOs in the SME scene. We want to have more bond issues. We want to have more equity raisings. But then ESG comes across. And my statement is that ESG reporting requirements overburden SMEs and will make it much more difficult to raise any capital in the future. And we've seen it in Article 8 in the Sustainable Finance Disclosure Regulation, where fund managers were requested to classify their funds, and respectively, they had to classify their investments. And many SMEs were not able to classify as Article 8 companies or Article 8 investment funds because they simply had no ESG data. And if you look at the funds rating, when you classify a fund and you want to become an Article 8 fund, and you have a lot of SME investments that do not provide ESG data, you simply have to get rid of that stuff. Simply divest SMEs. So that is completely contradicting what Capital Market Union likes to achieve. And there the question is, we have two sides of the coin, but obviously there is no real linkage. And this is something we urgently need to discuss on a European level. And looking at the perspective of an SME issuer, he doesn't have an ESG specialist. These guys are not trained. If he wants to hire an external expert, it's not available because the bigger companies are paying higher fees. So it's very hard for SMEs to set up an ESG strategy, to set it up. And finally, SMEs, they are lacking trading liquidity. Therefore, it's still an issue to invest in SMEs. And now ESG topic is coming on top, making it even harder for institutional investors to invest into SMEs. Fully contradictory to the Capital Markets Union and its 15 action plans. So what's the possible solution? If we want to have investments into SMEs, either at the threshold of 200 million, 500 million, or even 1 billion, I think it could be a good solution that these companies set up a basic ESG strategy, where they simply say, okay, we have understood the message. We will define certain ESG standards, and we will define also KPIs, and we will set up an agenda where we like to be in perhaps 5 years' time. But during this period, I think the basic strategies should be sufficient for investors to classify for investments into Article 8 funds. Because if we do not do it, we are really causing big, big trouble in SMEs. Thank you.
Opinion on the latest development in trends in ESG.
Latest trends and developments. I would like to structure it in two ways, in two perspectives. One is the investment perspective, where I would say we have now many different additional, let's say, restrictions. On the one hand side, as we heard, the regulatory agenda is definitely something that cannot be ignored. But within all these different scenes, I would say most important for me is the march towards net zero, the science-based target initiatives and all the related initiatives like the Glasgow Financial Alliance for Net Zero is definitely something that will dominate the agenda from my perspective for the next couple of years, because the alignment of, let's say, providing capital towards the right directive, and also to safeguard the planet from an investor's perspective and allocate the capital in the right way, is something that is for sure on the agenda for the next couple of years. Apart from this, from an investment perspective, I found quite interesting and important that the more illiquid parts of the markets will also be coming into the focus. We heard it with SME, we heard it also with partly with fixed income, and I would echo this because something like infrastructure, listed or unlisted, also something like private debt, and also real estate are areas where I would say that ESG integration also is really taking up speed. Data availability is improving, and we have more and more, let's say, something like a look-through, not comparable towards with the listed names, but at least it's developing in that way. So integration in liquids is also a big topic in general. And last but not least, I think that still also a lot is to do to integrate ESG really on a holistic basis towards larger portfolios for the asset allocation work. So talking their own book, but this is for me something where definitely a lot in the market can go on for the next couple of years. So this is investments. The other part is data, and data, seeing the development now for many years, we have a kind of double speed, so to say. We have on the one hand side really light speed for all the additional data that is offered by ESG providers on biodiversity, on all different things. So it's developing really, really quite massively. On the other hand, we have the total need of the regulatory data that is needed from next year's onward, where we simply don't have an improved data quality. And this is a total mismatch of the aspirations on the one hand side, and let's say the real foundations where we rely on the other hand. And there's a disconnect between what we as investors have to report and what under the new CSRD, as we also heard in the morning, will be reported in 2024 or 2025, probably earliest. And also in the CSRD, there's something like green capex or green revenue not even mentioned. So hopefully then for the next update, this will be included. But we have the mismatch of what we, from an EU taxonomy perspective, as investors, have to disclose, and what the firms are providing. It's a huge disconnect, and this is something which is really down to the foundation of our business, where I would say we should really take up speed in order to overcome this disconnect of data need and what is provided. And hopefully we can find a solution also with, let's say, what the EU has already promised a couple of years ago, that we have a kind of basic data pool for all these, let's say, foundational data needs. And I would say there's also a lot of pressure, not only on the EU and on the companies to provide it, but also maybe on the ISSB as a new standard setter in order to also present some good indications there, because this is urgently needed. And I think we really need to fix the foundations where our business is relying on for the next couple of years. Otherwise, we will have imperfect data, which is estimated by ESG data providers. And let's say the fuzziness even increases. So therefore, there is a clear, let's say, need to overcome this. Otherwise, all what we have as a political agenda or regulatory agenda is prone to be at least based on data which is let's say only imperfect. Yeah, with this, back over to you.
Thank you very much. Yeah, I've seen that was quite a bit to digest in the first place after the lunch break, but you have seen now 4 very different statements from academics, investment professionals, coming from 4 different angles of the business. And I'm just wondering whether this already triggers some questions from the audience here in Frankfurt and or from the online audience. Good. Then I would like to continue in a way that we have seen a bit in this morning's session. Ruben already outlined in his climate goals the road to net zero. And I'm just wondering what you think we should expect the road to net zero, especially the alliance we have already heard from on the asset management side, how this should be developed, and what you, from your point of view, consider to be the most important obstacle or even obstacles in order to really materialize these targets, which are very ambitious, even in 2030.
I think what Gunnar just said is very important. We need really to set sound foundations. And this, of course, contradicts with speed. But if we generate the wrong set of data, it will slow us so much in the future that it is really worth talking, describing, analyzing, and really setting the framework the right way. And especially, and that's again important for SMEs, when you talk to an SME and he's completely shocked to discuss about EU taxonomy, about papers, 500 pages and so on and so forth. And when you then come up with an idea that you say you can do it this way or that way, or even that way, or perhaps it will be completely different in 2 years' time, we are losing these companies, because it takes so much management time, and it will hurt the companies, that I really think it's absolutely top priority to have sound foundation. And this is where I completely couldn't agree more with what Gunnar said.
Anyone else on that question? Alex, please.
Thank you. Regarding the SMEs, I mean, thinking about the regulation, the CSRD said very clearly large companies, which means 250 plus employee plus revenues. I think our understanding is that a company with more than 250 employees is probably not large. I think this is somehow the thing we are discussing about. For the SMEs, I think Patrick pointed it out this morning as well. There will be an extra reduced standard from an European perspective, which will not be mandatory. So therefore, I think when we talk about large companies with more than 250 employees, it's definitely something different than talking about companies with 100 employees. But I totally agree, even for those companies, it will be a challenge. Especially because the CSRD links it to the taxonomy. So that means also those companies with more than 250 employees have to apply the taxonomy if they are eligible. But I think there's one thing that is important, because we are talking here from an investor's perspective. And my opinion, my feeling is that the regulation we see right now is not only directed to investors. The target group are all the other stakeholders, and especially also the politicians. So therefore, I think as an investor, it is totally understandable to say, well, this is not in our interest. And also what Gunnar just mentioned, the different speeds we do see in terms of what needs to be reported, and the quality of information is something from an investor's perspective, which is very serious. From the perspective of the other stakeholders, it might not be that that material as what we are discussing here.
Gunnar, please.
Yeah, maybe one additional from the SPTI perspective. So I think it will not be, or let's make it the other way around. Investors have fully bought into it. So investors have supported all these race to net zero, as we see from the assets under management that are behind the G Funds Alliance. I mean, we have more than 120 trillion in US dollar of pension and money managers, asset managers, money that have subscribed towards these targets. So I would say that's really a huge pond of the institutional asset managers share globally. So there is complete support. Where I'm a little bit more worried is the buy-in from the corporates, on the other hand, because when we are looking at those companies that have signed a kind of SBTI or a similar target, we are talking about less than roughly 25% of the globally largest companies. So it's still relatively small, and we have roughly 1,500 names only globally supporting it, roughly. So that's a disconnect currently of firms and also asset managers. So I think that needs to be overcome. That also needs to be clear from the investors and asset owners perspective that also companies shall commit to it. Otherwise, we won't be sufficient and successful. And then, of course, it's about the data, the estimation of those things. Yeah, again, it's new data, but it's also fixing the foundations, because a lot of stuff is simply still in the air. Simply thinking about Scope 3 emissions, where only a fraction of companies are reporting Scope 3 emissions. And even for Scope 1 and 2 emissions, what the largest companies are reporting is relatively meager, with roughly 45% of the largest global companies that are reporting Scope 1 or 2 emissions. So it's still relatively small, and the rest of the data is estimated. And you see there's a disconnect, and firms also need to hear the message of investors that we need more. And there is, for me, also something that needs to be fixed in the next couple of years, and not only on a European level, but again, on a global perspective. And that might be, apart from definition and standard, probably the most important thing, that this becomes a more and more global march, and not only from the European side.
When we talk about latest trends, we also have to incorporate and take the regulator into consideration. And we have heard this morning several times. There was the decision of the new standard setters, the new ISSB, International Sustainability Standard Board, being located in Frankfurt starting almost 6 weeks from now. And so I'm just wondering, what would you expect from this decision? Because this could be a real game changer, having such an important regulator in the core of Euroland. What do you expect to happen next year as far as the corporate sustainability reporting scene and environment is concerned?
I mean, the expectations are so large that probably it will be difficult that the ISSB now can fix anything that hasn't been fixed from the EU side, or from the CESB, or from other frameworks in the past. So it's a difficult task, but nonetheless, I think it's the right setting. That from a global financial standard setter, you now have also the standard setting in the ESG world, because at least my hope is that we, with this perspective, can generate this global perspective that is urgently needed also for the ESG indices and ESG criteria. Otherwise, yeah, we will continue complaining about the ESG data landscape. But once that companies can also trust in these data and standards, that they can be reported everywhere, also globally on a let's say, aligned basis, then maybe we'll also have a better buy-in from the companies. And then we as investors are also happy that we can use more standardized data.
Alex, please go ahead.
Yeah, I couldn't agree more. I think this is really huge success, especially the way how Frankfurt win the headquarter of the ISSB. I mean, it was a strong support of corporates, of politicians in the state of Hesse, and also the federal government. So therefore, I think this support would also makes it necessary that the implementation of ESG reporting starting from Frankfurt to Europe will definitely increase. And I think what is extremely important, what ISSB did, and I think that's extremely smart, that they are not only cooperating, but they're planning to merge with the Value Reporting Foundation, so SASB and IRC, the International Integrated Reporting Council, and also with CDSB. So the large players are all involved there. So I think if Frankfurt will take this opportunity to make it the hub for sustainability reporting, I think that would be great. I mean, the German government announced in their coalition contract yesterday that sustainable finance, that Germany should be the sustainable finance headquarter in, and not like they said before, it should be a sustainable finance headquarters. So there's a huge difference. So I think this will give a push not only to Frankfurt, but to Europe in general. And I hope that all companies, politicians will support that.
Right. And Thorsten, I think we shouldn't forget that DVFA also strongly supported the initiative. And 4 weeks ago, when we had our annual asset management forum here at the same place in the center, we had two of the main protagonists with us, Mr. Wiesoy from Metzler and from the Frankfurt Main Finance area. So DVFA also committed itself towards this initiative. So I think that was a great win with almost 200 associations and institutions supporting Frankfurt as a city. In the meantime, I'm just wondering whether we got a bit more awake after the lunch session and whether there could be some additional questions here from the room or from the online audience. Would that be the case? So Florian is nodding. Good.
Frank,
please.
Let me ask a question. What I'd like to know is if that is still valid. I think back in March, I heard an interesting lecture about correlation of ratings. And the final statement was the correlation among financial credit ratings is probably 80%, while looking at ESG ratings, it's merely 20%. Is that right? Is it wrong, or has it changed? If anybody could comment on that, that would be helpful.
Ask the PhD specialists.
I mean, typically the framing is that the fixed income world has a correlation of the bond ratings around 0.99. So it's said in some highly quoted papers. Actually, it's more 0.93. I've figured out myself, but let's assume it's really high on average. On the ESG world, we have more something like 0.5. But it really depends on the ESG rating agencies that you compare, and it can be also as high as 0.7. And also, if you then look at certain, let's say, subtopics, it can be also as high as 0.8. So interestingly, the governance aspect that seems to be highest developed is typically relatively small compared to the ENS section. So long debate about correlation against the classical bond rating, but I think if you consider that the ESG ratings are measuring something totally different than a classical bond rating, which is just about the coupon and the payback, whereas ESG is a multi-dimension of different topics, I think it's still considerable that we have such high and positive relations. And I think there's also a lot of debate. So where are these correlations in particular, where they differentiate and so on and so forth. But, I think if you adjust for some providers that have a lower correlation, on average, these, let's say, more mature, the older ESG rating providers have correlations of as high as 0.7, which I think personally is quite okay. Yeah? Considering this multi-dimension that we are measuring, and this needs to be always bear in mind, and nobody is questioning the correlation of equity ratings because they are also measuring something different. And so therefore, it is a little bit misleading when we always put so much stress on bond ratings versus ESG ratings. I would say let's also focus more on the equity side and consider this multi-dimension that we have.
Good. Okay. Thank you very much. And now we have a question in the room in the first place from Jose Luis.
Is following the argument that you have. I am fully agree with you about the ESG ratings. This person is not fair to compare. But for me, let me a joke. Probably is more. I'm afraid that it's more risky that all the financing ratings are so correlated. For me, it's more risky than the others. But my question is about how you see that if you see that the new standards and all this movement about disclosing, do you think that it will improve dramatically the assessment of the ESG ratings or really not? What is the impact of this movement? Because I'm afraid that I have some days I am I have doubts about that, but I am interested in your opinion. Do you think that these new disclosure standards will improve really the assessment of the correlation on the ESG world or not? And what is your opinion about the IOSCO requirement of the ESG raters trying to avoid the conflict of interest that they observe at this moment?
Would you ask Barbara?
Yeah, I think from a financial analysis standpoint, it's crucial to have a standardization of non-financial KPIs, because it's the only one way to make comparison within a sector, within a region, or whatever. But this is the main, sorry, the main lever that we can have to make this kind of work, and also to link this non-financial data to financial data, because at the end, what a financial analyst is looking for is for this correlation, to assess the materiality and to project on the future what could be the credit profile or the equity value of the issuer, and yes, what can be this how these ESG factors could affect in the future the business model, the EBITDA, whatever. And if you don't have an homogeneous framework, if issuers are not disclosing the same way, the same data, you cannot make this peer comparison.
Do you think that the current development of the standard go in this way? Because I think that this is outside of that. Most of them are not related to the metrics. They are making another animal, repainting the wheel, trying to merge different aspects. How we are measuring ESG with the ESG protocol, for example. Nobody is questioning that.
Yeah.
This is the problem. The problem is that the ESG protocol was made in 2006.
No, I agree. We are still far from.
We do have room for one more question, and as Fabian has one from the online audience, I would like you to raise the question, Fabian.
Okay, yeah, so one online participant asks, I would appreciate if you could provide your opinions about the future of GRI after ISSB emerges.
There we need someone from the EFRAG front. Alex.
Yeah, I mean, the GRI is very, very closely working together with EFRAG right now. That means a lot of the GRI criteria will be copy-paste into the EFRAG standard. There will be some additional standards, of course, that will not be 100% GRI, but a lot will be adopted. GRI will definitely be still be useful, because they will provide more reporting standards, because I think that the regulatory standard will be a baseline, of course much higher baseline compared to what we had before, but there will still be space for voluntary reporting. So I think that other voluntary reporting standards will of course survive, but probably we do see this consolidation. We do see with the ISSB, with former SASB and IRSC. Probably we do see something like that in the standard setting world as well. But I think we have to wait until we do see the standards EFRAG will disclose. For if you look at the climate standard, which is already published, you see that the granularity is very, very high. The same will be the case for water and also for biodiversity. So therefore, yeah, I think we will see a lot of GRI in EFRAG, in the EFRAG standard, but there is still space for voluntary reporting.
Alexander, thank you very much for this detailed question and this detailed answer to the question from the audience. And with this, I would like to close down the panel. This is an example how 45 minutes can fly when there are enough questions and there are enough topics to discuss. So in the first place, I want to thank you, and I want to thank everybody from the audience, and I want to give you a big applause to the panelists. We would like to elaborate and give a bit of an update about the CESGA program, where we are right now and where we are heading to. Perhaps, Alex, if you can elaborate a bit on that. And Klaus also asked me that I should give you the EFFAS Essentials with us, so that you can also comment a bit on that one in addition, because it also belongs to the overall program of the EFFAS ESG entity.
Yes, yeah, thank you very much. Maybe I would just start with the ESG Essentials, because the idea of ESG Essentials is that